Mentions of dollar debasement in news headlines have just surged to their highest levels in 5 years. The last time these words dominated headlines was back in 2020 and 2021. That period was followed by one of the sharpest drops in the dollar's purchasing power, the highest inflation spike in decades, and a notable economic slowdown in 2022. So worries about the dollar rapidly losing value are now building once again. But to understand whether those concerns are justified, we need to look at the main force that can weaken the dollar: how much new money the government is creating. And this chart shows just that. When the line rises, it means money is being created at a faster pace. When it falls, money creation is slowing. And when it drops below zero, it means the amount of money actually circulating in the economy is shrinking. Under normal conditions, money supply grows gradually, usually around 5% per year, which is just enough to support economic growth. But concerns about debasement begin when that growth suddenly surges. And if we look closely, there's a very clear pattern behind those spikes. In 2002, money supply growth spiked above 10% after the dot-com bust. In 2009, it surged again after the financial crisis. And especially after the pandemic, the growth rate spiked to more than 25% in a single year, something the US had never seen before. In each case, the government stepped in to stop an economic downturn from getting worse by printing money and injecting it into the system. More money circulating means banks have more to lend, households and businesses can borrow more easily, and the government can send stimulus directly to consumers, all of which boosts spending and keeps the economy from stalling. But while printing money works in the short run, it usually leaves a bigger problem behind. Every major spike in money supply growth has been followed by a more rapid drop in the dollar's purchasing power, like here in 2002, 2009, and again in 2021-2022. That's because when dollars flood into the system, each dollar becomes worth a little less. And when that happens, everything from groceries to rent becomes more expensive. People feel poorer, they spend less, and the economy slows. It's a cycle where the short-term solution ends up creating long-term pressure. By the way, if you want access to fast market updates, join our Telegram channel today. We post short, clear updates on everything that moves stocks, crypto, and global markets. Use the link in the description to join and get the updates that matter most. Now, bringing it back to the bigger picture, right now money supply growth looks calm. It's growing below 5% a year, which is what you'd expect in a stable economy, not even close to the explosive surge we saw in 2021. And since there's no recession, you'd think there's no reason for another wave of money creation anytime soon. So logically, a rapid debasement shouldn't be on the horizon, right? Well, this time is different, because the pressure for more money printing isn't coming from the economy, it's coming from somewhere else entirely. See, the United States has been running large budget deficits for the past 25 years, meaning the government consistently spends more than it earns on things like Social Security, healthcare, defense, and other programs. To cover that gap, the government borrows money by issuing treasury bonds. Over time, those deficits have added up to a record $38 trillion in national debt. But the real issue isn't just the size of the debt. It's the timing, because roughly 1/3 of that debt is maturing within the next 12 months. In simple terms, the government has a huge bill coming due all at once, and that means the government must issue a wave of new bonds to replace the old ones. But as deficits keep widening and debt becomes larger, investors naturally become more cautious. Some may start buying fewer treasury bonds. Others may still buy, but only if the government pays them a higher return or yields to compensate for the extra risk. Both outcomes are bad for the government. If fewer investors buy, the government can't raise the money it needs. If yields rise, borrowing becomes more expensive, which could push the deficit even higher. And if that pressure becomes too strong, that's when the Federal Reserve often steps in. They do it by creating new money and buying those government bonds themselves, a process known as quantitative easing, or QE. In fact, the Federal Reserve has already hinted that this shift may be coming. Right now, they aren't printing money to buy bonds. They're doing the opposite, something called quantitative tightening, which removes money from the system. But the Fed has signaled that this tightening cycle is coming to an end, and many economists believe that in early 2026, they may start buying government debt again. So for the first time since the pandemic, the setup for another round of money creation is forming, not because of a recession, but because the government may need help refinancing a large amount of debt. That means we could possibly see the money supply start to rise again from here, but the impact depends entirely on how fast that happens. A slow, controlled increase could support the economy and help reduce borrowing costs for the government. But but a rapid spike like the surge we saw in 2021 could be followed by rapid dollar debasement, push inflation higher again, and eventually weigh on consumer spending and economic growth. For investors, that makes tracking money supply and the Fed's policy signals more important than ever. At Capital.com, we'll continue following how purchasing power, liquidity, and money supply interact to shape the economy and what it all means for investors. Hit like and subscribe to stay tuned. Thanks for watching.